Now, CPI is at 3.2% year-on-year in February, unchanged from January. The main contributors to the annual print are housing and utilities, food and non-alcoholic beverages, along with restaurants and accommodation services. Month on month, there's an uptick of 0.9%. And while the SARB does not use a single print to make its MPC decision, what does the trajectory suggest? Independent economist Elize Kruger joins us with her analysis. Elize, thanks so much for your time this afternoon. So as mentioned, inflation on an annual basis remaining unchanged at 3.2%. Core inflation falling to 3.4%. I guess those indicators are quite positive because we are at the lower end of the SARB's target range.
Yes, indeed. And very good news today on the inflation front. Both metrics came out better than market expectations, and by quite a margin, especially on the headline number. Expectations was for the number to be around 3.4%, coming out unchanged. So on the day, a good number, and I think a number that could have an impact on the deliberations of the Reserve Bank.
So that month-on-month increase, nothing to be too concerned about?
No, because February is a high survey month, as we call it. So quite a few surveys, come through the numbers in the month of February, specifically the medical aid and medical services component of CPI gets measured in the month of February. And then we also had a fuel price hike, both on petrol and diesel, that were quite hectic in February. I think about 82 cents per litre for petrol and just more than R1 for diesel. So those were expected. So I would say, and given that if you look at the 0.9 you mentioned, 0.6 of that is the medical contribution. And that's only a once-off coming through, once a year. So now I'm not concerned about that. I think the 3.2% unchanged is quite a good outcome on the day. And it also lowers the point from where we forecast for the rest of this year. And given that it's quite a bit lower than expected, that does make a difference in terms of the profile for CPI for the rest of 2025.
And we'll get into your expectations for the year in just a bit. I just want to look at the main contributors to the annual number: housing and utilities, food and non-alcoholic beverages, as well as restaurants and accommodation services contributing the most. I want to touch on that food inflation number increasing to the highest level in 4 years. I don't know, something to be concerned about, or is it because we're at the top of the year and we are seeing those prices increasing a bit?
No, let me say, I think, the numbers you quote there, I'm not quite sure. On the food side, we've got 1.9% on an annual basis. Food and non-alcoholic beverages, 2.6%, compared to this time a year ago. So those are quite moderate, in the cycle still. In terms of contribution, yes, those are the heavier weighted items within the basket. Yes. And with the revision of weights, we have seen that the food basket has increased in terms of weight. So on the annual basis, yes. But if you look at it just for the cycle, I think food prices are still quite low at 1.9%. As we see it at the moment, our fuel price inflation is still in deflation environment, so i.e. fuel prices are lower compared to a year ago. And we're also now heading into April, where we will hopefully see another a nice cut in our fuel prices. At least it will offset what we have seen in February in terms of a hike in fuel prices. So for me, there's a very moderate undertone in today's CPI numbers.
Let's just get your reading then on inflation for the year, also considering that we'll be getting that VAT hike coming through in May, as well as some of those global risks at play that could influence consumer prices moving forward.
Yes, Ntoling, if I look at my CPI forecast where we stand now, incorporating the May 0.5 percentage point hike in the VAT rate, generally speaking, that is an effective increase of about 3.3% on those products where VAT is levied. Having said that, one must remember that many of the retailers out there might absorb part of that increase and not give it through straightforward into higher prices. But having incorporated that as well, and near-term expectations in terms of fuel prices, the latest news on electricity price increases that are also slightly better than what we expected a couple of months ago. Now, I'm looking at an average headline CPI number of 3.7% for 2025. quite a bit down from last year's 4.4%, lower than the Reserve Bank's expectations at the previous MPC meeting. So no, it's quite a, I would say, a favorable inflation outlook. And if I could maybe quickly throw in the global factors you also mentioned. Yes, there's some risks out there in terms of potential play out, but I think one should just, acknowledge that those risks are not one directional. It's not just everything's going to go up and prices go up and inflation is going to run out of control. We're actually sitting now with an oil price at $70 per barrel. And that's partly due to what's happening globally at the moment in terms of, on the one side, the impact of the trade war that's perceived to be negative for global growth, putting a downward pressure on the oil price, on oil demand. And on the supply side, actually, what's happening between Russia and the US in terms of negotiations about the Ukraine war is actually resulting in expectations of more supply of oil on the market. And now we're suddenly sitting with a $70 per barrel oil price, which is very beneficial, not only for South Africa, but also for the globe. So just to say that, yes, there are risks, but they're not all just pointing to upside in terms of prices.
So then does your positivity around inflation also filter through to your expectations for the SARB tomorrow? Are you expecting a cut come 3 o'clock tomorrow afternoon?
Well, yes, I'm in the camp that is advocating for a further cut in interest rates, because I really do believe we've got a window of opportunity. I mean, sitting where we are now in terms of, average CPI below 4% for this year, our repo rate is stuck at 7.5%. So you are talking about a real repo rate in the order of 3.8% if you work on the averages, and above 4% if you look at the current levels of inflation. So it's quite a punitive real interest rate environment for an economy that is struggling to get to 1% growth. So for me, that really suggests a window of opportunity. And I do not believe that a 25 basis point cut would be considered to be a particularly brave or wild move from the Reserve Bank. I mean, we have quite a bit of fat built into our real repo rate as it is. So I think a slice of there could just be good for the economy that's already, having to handle an additional, fiscal policy constraint on the economy. And, it's just headwinds from other sides. And especially given that the fiscal policy side will just subtract from growth, given what's suggested in the budget. I think the monetary policy side could be a bit of an offsetting factor here.
Elize, thanks so much for your time and just sharing your insights and unpacking that CPI print with us this afternoon. That was independent economist Elize Kruger.